Welcome back to Deal Flow Live, ladies and gentlemen. This is the show where we talk business transactions, all things buying and selling businesses. And we give you the deets on what you should be looking at if you're thinking of acquiring, buying, investing in a business, or if you're thinking of selling one. So pay attention to kind of both sides of what we're talking about here. Could be helpful whether you're looking to do a deal from either perspective. And if you happen to be watching this and you're thinking about a particular deal, whether it's buying a business or selling your business, feel free to send us a message, send us a note on LinkedIn. You can find us, either of us on there, Brody Vincent, Ryan Santo, and just let us know what the context of the deal is, and maybe we can help out. Maybe we'll review it on the show. But today we're talking about whether the private equity bubble is about to burst. Now, Ryan and I were reviewing this video that Ryan found earlier today, and their point was that there's been a lot of over leveraging in the private equity space, particularly in the area that we like to cover, which is buying small private businesses with the goal of later selling them after getting a return. What were some of the kind of main points that they were making, Ryan?
We can even we'll link the video down below. It was mostly targeting the environment where private equity was looking to get shareholder returns and what those were looking like, and how since the 80s and kind of 90s, when private equity was at its freshest, newest, they were getting crazy returns, 30-40% sometimes, and now they've kind of hovered more towards that 10. And the fact that some of the issues that many funds are facing is that when their turnover time or their fund closes, essentially, in private equity, a fund closing means the sale happens. In a mutual fund closing means it's gone. So it's a little different. Private equity closing is technically a good thing. They can't close their funds, so they will buy up these businesses in using kind of a rapid kind of a bloated model, essentially, kind of saying, if we can get this thing to cash flow X by Y, we can sell it for Z. However, 5 years ago, when that model of turn and burn was really at its peak and it was all cylinders, HVACs were going left, right, and sideways. People were 4 or 5 to X multiples on, small mom and pop shops. Right now, they are not selling. They are having to hold the bag on a lot of their leveraged companies. And I think me and you both have a very strong feeling about that. When we look to acquire a business, we're looking long-term strategies. We're not looking to load it up with debt, throw it off for a couple mil, and then just say, okay, it's your problem now. We're looking to build it for a long term. If we had to hold this thing for 10 years, we want that profitable 10 years. However, a lot of these private equity companies are saying, load it up with debt, buy a bunch more, package it up, sell it out, and get the payout, pay off the debt, and just rinse and repeat. And right now, it's not working. And a lot of people think we're about to come to a massive head with it.
Yeah, and it really it kind of proves a philosophy that you've shared a bunch of times, and I'm starting to feel more and more strongly the more information comes out about this, which is it's much smarter with a strategy like this to approach it with the goal of just building a good, solid business for the long term, than to approach it with the idea of buying it to sell it later. Now, if you end up getting a good offer on it and someone wants to buy it and approaches you and it's for a price that works for you and gets you a good return, then that's great. But approaching it with that being a requirement in the first place is, I think, where a lot of these firms have gotten themselves into trouble. And, what happens is they put together this strategy where the returns that they're trying to get come from the eventual sale, and it depends on that heavily, or primarily. And then they get to the point of, okay, we've gotten some growth on this company, or we've put maybe a few companies together, it's time to sell, and they're not able to get the multiples that they thought they could get before. And because of that, they're not able to get the returns that they modeled out. And so what do you do in that strategy? If you're completely leveraged on it, you have to take a loss on the returns. You just have to, because you set the wrong expectations. It was something that you didn't realize you weren't going to be able to control, but you set the wrong expectations. But if you set the expectations out in the beginning that it's going to be a long-term hold strategy, Then you get the returns. Maybe they're more modest returns even, but you've got good, solid returns, ownership in the company. And then if the right offer comes along, you could cross that bridge when you get to it. You could potentially take the offer if it's going to be a good fit for your shareholders.
I think to that point, many times the people who eat the brunt of that is the shareholders. A PE firm, everybody's getting paid, everybody's getting a commission sometimes, or people are getting management fees off of their businesses that are in their portfolio. So the entire time, these guys are getting paid, and when it doesn't sell, for it is, the investors are left holding their holding basically less money than they put in, or way less than they thought they were going to get out. If I told you, hey, give me $100,000, I'll give you $300,000 in 5 years, and I give you 110, well, you're thinking I could have just gone to the S&P and parked it, and in a year had on average 15%. So, that's one of the things that we always look at a business is when we are looking to acquire, we say long-term, if we get on investors, how can we say we're a safer bet and there's more long-term than the S&P 500? And that's really how we approach everything is if we're going to ask you for money, it's because we believe that we're not going to outperform it, but we're going to show you alternatives to where if you want to diversify, we can get close to that number where you're feeling safer about your money. So back to the strategy though. I think when you build a safe company for a long-term hold, but you're ready to sell at any point, you're giving the people who are looking to invest that safety net of we've structured this in a way that you can take it over and all the rails are up, all the all the safety checks are there. So it makes it a more appealing sale because we've done all this stuff to make it ready for sale in the idea of if it doesn't sell, we're still going to be making money and we're still going to be doing just fine long term with this thing. So like I think what we, kind of the phrase we use is build it for your kids. Build it like you're going to be dying and giving it to your kids. So if you do that, you're probably going to build the most structurally sound, most not safest, but most scalable company that you can. Instead of say, I'm going to load this thing up with debt, take out loans against it, buy a bunch more. But again, in that world, you're told, hey, you have 3 to 5 years. And then sometimes you're just dropped tens of millions and told, grab a bunch, shove them together, get this number and sell it. So now too many people buy, maybe there's a saturated market and not many people are doing it, or people get burned by buying companies leveraged up with debt. And they're like, wait, I didn't want a debt-filled company. I want something that actually cash flowed.
And what else happens when you take these short-term shortcuts to financially engineer the company to look profitable for a sale? You have to take these short-term strategies. You might end up walking yourself into something that ends up being a long-term or a bad long-term strategy. You might have to take these shortcuts and, start to burn the reputation of the company, depending on what you're doing. You might have to end up doing things that set the company up for failure in the long term because you're trying to get it ready for a sale so quickly. So it might actually end up hurting your ability to sell a few years down the road if you try to take all these shortcuts and all of a sudden the company starts to decline because you tried to move too quickly or you over leveraged yourself. So it's a little bit of just a better play for the outcome. If the outcome is a hopeful sale, building for the strategy of a long-term hold is still a better strategy because of that. You're going to make the right long-term plays that when a potential buyer does look at the company, they're going to see, okay, this was built with some real longevity in mind. And then the other thing is you're going to just have better negotiating power. Whoever needs the transaction to happen more or wants the transaction to happen more has less leverage in the negotiation if you do get into the negotiation table to sell. If you come to the negotiation table and you're like, you can take it or leave it. I'm actually making great cash flow right now. Selling doesn't really mean much to me. I got a few decades left in me to run this thing. And, I could care less or more. I could care less if I sold it right now, but if I got the right offer, I guess I'd look at it if you are able to legitimately have that kind of attitude with it and you're not coming with my God, I need to sell this to get my returns, you're going to have a better outcome because someone's going to have to make a more aggressive offer to get you interested.
Yeah, and I think some people may say, well, no, that's just called running a business. You scale. You want to make a long-term, start a business to long-term. Yes and no. I mean, there are some people who start businesses like Silicon Valley is basically start a startup, get a funding, and sell. I mean, that's kind of how over the last 5-10 years, businesses have shifted from long term to this kind of sell to larger because there's way more money to be made. But um, I think what we're seeing now is this trend both in the company, but I think as kind of people, we've always kind of had that. We've talked about roles, we talked about stuff, but everything, ironically, everything we've ever done has been longevity based. Like you've never gone into a business that you've been working with and tried to figure out, okay, how can I basically put this thing on a 5-year pedestal where it'll crumble after 5? I just need it to look. Everything you've ever implemented into a business has been long-term fixes that inevitably help the business grow. And many times people say, wow, I'm actually going to stick around, which I think is kind of over the last 6 months where Scale for Sale has become more of a forefront company where it's not just designed to help you scale to sell the business. It's designed to make your business run smoother and make you enjoy running your business a lot more and remind you why you started it. So weirdly, we're kind of coming a full circle here where we're like, we want to buy businesses, we want to scale them, we want to make them larger, find more ways to make them grow. But we never want to be in a place where we have to sell. We want to be in a place where if we want people to want to buy the businesses that we run. Like, oh, Scale for Sale ran this business. Must be pretty good. They got great stuff in place. This is probably almost a turnkey situation. I want to buy that one because I don't want to gamble on a business.
That's exactly right. The businesses that we're investing in, that we're building right now, we want them to be businesses that buyers froth over, that they want to get in line to have a chance at buying. That's the kind of business that we look for in the first place to invest in or purchase, is something that gets us that excited and that we can potentially get some good arbitrage on, whether it's a pre-existing relationship or pre-existing knowledge of the industry or some expertise of like how to pull the levers of the business. We look for something we can get arbitrage on like that and get great returns right away from the growth. But I think, because of this, if I could sum up what our big takeaway has been from this in one kind of little soundbite here, I think it's focus, whether you want to sell your business in the future or not, or whether that's something you want to optimize for the outcome of, build like you were going to leave it to your children's children, and like it's for a legacy, like it's a legacy business. Build like it's a legacy business no matter what, and you might just get the outcome that you're looking for.
In most cases, you'll get probably more than you thought. So
that's right. And you'll have optionality.
Yeah, once you're in control, it changes everything.
If you heard anything that you liked here on the way that the way that our philosophy works for investing and how we look at businesses, and maybe you are a business owner, maybe you clicked on this because you're curious whether you should be trying to sell to private equity in the future, go to scaleforsale.com. Just check out a little bit more about what we're about. I had a business owner that we started working with recently to kind of help him grow and scale his business. I had him tell me recently that when he came to our website, the copy, actually, first thing he told me is it could look better. So that's a fair point taken. But the other thing that he told me is that when he read the copy on the website, the actual words on the website, is that he felt like it very much summed up how he was feeling about his business and what he was kind of looking for. So if you are a business owner and any of this resonated with you, go to scaleforsale.com and just check out again what we're about and what we do. And we would love to work with you if it makes sense.
For sure. We see all types of businesses, and we see business owners from, multiple different countries, states, continents. So wherever you are, we might be able to do something with you. So just drop us a line, go to the site and fill some forms out. We'll get in contact with you.
And we'll see you on the next one every Tuesday, right around 6 p.m. Eastern Standard Time. Till next time, stay classy.